G'day and welcome to Shares for Beginners live on Facebook. I'm Phil Muscatillo and joining me tonight is Evan McQuire, who is my second guest ever on the podcast. Evan's on the front line every day, researching, trading, analysing and generally living and breathing the market. Stockbroking, a day in the life of Evan. Evan, you're the co-founder of MF&Co Asset Management, which is a boutique broking and investment firm. You're on the front line every day watching the markets. How did you get into this caper?
Thank you for asking, Phil. Well, it's a long story, but I'll try and give you the cliff notes. I had an interest in financial markets, probably in mid to late teens. I was into music, as you know, and I did do some music studying. I played in bands and that kind of stuff, but I quickly realised that wasn't going to work for me. So I decided that I wanted to move into stockbroking, become a private client advisor. And I just basically went through the motions. I had a couple of family friends that were traded stocks, and one particular gentleman was involved in a publicly listed company, took me down to a broking firm, sat there for half the day and with a private client advisor. And I fell in love with it. So I thought, okay, what's the best way of me doing this? So I got some advice, and I basically started from the very back. So I started as a share clerk in a share registry, which we still have today. This is the old Cubers and Lybrand share registrars. And I started there, moved from there over to computer share, worked on the AMP float there, special projects team, went from there to McQuire Bank, started doing more back office operations there, went from McQuire Bank to HSBC, was there in operations for 3 months, moved to front office, been in front office ever since. I was a dealer there. Then I went to another place where I became an advisor. Then I ended up running that particular desk, went from there to another broking firm, was there for a few years, was head of retail, head of private clients, was still advising. And here we are, set up MF&Co with my partner, Henry Fung. And I've worked with Henry for about 10 years. We work together at different places, and that's it.
Is it fun every day for you?
Yeah, it is. Look, I mean, it's like anything. I mean, you have your good days and your bad, right?
Mm-hmm.
And, you know, but every day is different. That's the thing with markets, is that every day is generally different. You don't have too many groundhog days. Although I will say the way the market's been over the past few weeks has been, you know, we've been sort of stuck in a band. But otherwise, to answer, it's every day is unique, every day is different, and I love it. It's awesome.
I've just got a comment from David Horton. Hi, David. Is my volume okay now? I've turned it up. I think I had the microphone down a bit too low. Is it coming through okay?
I can hear you fine.
Yeah. No, one of the listeners, David Horton, has just mentioned that. So I can see I've gotten a lot more level and gain now. Okay, so talk us through a typical day at the brokerage. I mean, what do you do when you get up? What's the first thing obviously, do you have some breakfast and then get and have a look at what's gone on overnight in the world markets? What's the typical day like?
For me, a typical day is I'm up at 4. I'll have a quick look at the markets. I go to the gym. I'm at the gym pretty much 6 days a week. That works for me. It's good for me mentally and also physically, I hope. And come back. I'll have a coffee. By that time, I've already had a squeeze of what the market's already done. Check the futures, see what the SPY's done, see what the currencies are doing, see what happened offshore, some commodities, and then you know, usually once I've showered and done all those things, I'm ready to rock by about 7 o'clock, 7:30. And then from there, it's generally just, again, seeing how the day is going to shape up, reading announcements, And then you've obviously got all the admin stuff, so account opening. Somebody needs to transfer funds out, somebody wants to transfer funds in, all that admin related stuff. Compliance is a big one, and so we have to make sure that we're on top of all our compliance and make sure all the guys that work with us are doing the right thing in terms of.
Can I just interrupt here? It's not sounding like Wolf of Wall Street at the moment.
Yeah, no, it's not. It may have been. Look, it may have been back in the 80s and 90s, and there's I've seen plenty of things, and but it's not. It's generally it isn't like that. It's a job. It's like if you're in a factory doing widgets, you're making widgets. It's kind of the same thing. We have things that we got to do every day, and we've got to be compliant and all those kinds of things. So yeah, it's definitely not that romantic or bizarre.
What about talking to clients? I mean, obviously that's the other thing you're doing all day is you're on the phone chatting with clients and managing the clients as well, I'm assuming.
Yeah. So yeah. I mean, an average day, probably get a couple of emails, maybe some texts, some phone calls. What's happening with this? What's happening with that? Can we get set here? Can we get set there? And I'll make calls with ideas to clients. I'll call people up and say, look, this is happening. Are you interested? So it's basically looking for so in a nutshell, what do we do? We're looking for ideas and opportunities for clients to make money. That's it. That's what we do. So it's fielding calls, fielding emails, and some days are busier than others. So if we talk about even the last week, we've had a little bit of weakness in the market. I think people might get a bit edgy if they start to see when you start seeing days where the Dow's off 400 or 500 points, people are going because they're just so used to this absolute melt up. March was a busy time this year. We were, like I think a lot of guys and girls in our game, we were flat chat for a month, 6 weeks. It was just non-stop.
Yeah, no, it's interesting. So with the markets at the moment, it has been a steady grind, hasn't it? It's been like the steady grind's really in the US markets, whereas the Australian market's been much less of a steady high grind. Is that the way you're seeing it?
Pretty much. I think you did right there, Phil. Since about June, we've very much traded within a 300 or 400 point range. It's sort of on the S&P ASX 100, ASX 200. Sorry, you're probably looking at about above 5,800, and we just can't seem to get through that sort of 6150 level. We just can't get through that with conviction. So sort of 61, 56, 57, if I'm going to be sort of precise, but that's the kind of level where we haven't been able to get through. And on the other side of that, I'm seeing interest when the index, we're sort of 58-ish, 5,800, 5,850, 5,900, people start stepping in. So definitely we haven't had the same, the momentum and, that sort of grind higher that the US has had. We've nowhere near it. Although, if you look at the Aussie dollar has definitely had a big run up. I mean, even today it got through 73. So that maybe that's a little bit of a cap. It's a difficult market to read at the moment because there's so many things that are. There's a lot of so for example, the US market there's just so much hype and froth and retail investors piling in doing basically tech company options. So we're talking about Tesla, Amazon, Google, Alphabet, Apple. I mean, it's just there's an absolute army of retail investors, and it's not. They're trading like 2 or 3 contracts. It's not huge volume, but there's just an army of them. We're not seeing the same kind of thing here, but in terms of options, we're busy doing options because that's what we do. A lot of options. We do a stack of options, but you know, I'm not. We're not getting the same buzz with our local market. It's not there.
And just to be clear, you're talking about the ASX 200.
Correct.
And that's the top 200 companies on the Australian Stock Exchange, well,
Correct.
obviously. And this is the big market indicator for Aussie, isn't it? It's like the S&P 500 in the United States, or FTSE in England, or so forth. And so amongst those companies, I mean, the composition's changed over the last few years, hasn't it? I mean, previously it's been the banks and it's been the miners, and now suddenly we're seeing other companies coming in and taking the place of some of this, aren't we? It's the composition's changed, the feel's changed, hasn't it?
Yeah, there's a lot of what the way I'm viewing the market at the moment, in particular, especially in the US, but even locally, there's always you always get these moments in time where there's fad type stocks, fad type sectors. Okay, so tech is I'm not saying it's a fad, but what I'm saying is that people are piling into companies that they know very little about, and it just has this feel to it, like before the tech wreck. Now, I'm not saying there's going to be a tech wreck, because a lot of the companies in the US make money and all that kind of stuff. Sure, they've got a high PE multiples, but that's always been the case. But yeah, there just seems to be a lot of people getting into, this sort of the tech space. That's what I'm seeing at the moment.
Yeah, and things like, I mean, we can't go anywhere without mentioning APT, and really, it's not even a tech stock, is it?
No, it's not.
But Afterpay, I should say. Yeah.
Yeah, Afterpay. Yeah, it's not. It's just it's basically a deferred payment scheme. You know what I mean? It's and it's. I mean, we've been long that stock for a long time. Same with Zip. That's the stock that we covered Zip a long time ago, well over a year ago, I think. So, but there's obviously a model there, and people are clearly, especially at the moment with the pandemic, people are clearly committed to using the service, and people are committed to buying the stocks. So so that's now, irrespective of whether or not they make $100 million, make $100,000, make $1 billion. There's a lot of I think there's a lot of hype with some of these things.
Yeah, there is hype, and obviously we're not recommending anyone buy it. It seems incredibly expensive now, some of those stocks. I think something fundamentally has changed. I mentioned before, I was chatting with Andrew Page from Strawman today, the last person who was on this Facebook Live.
Right.
And we were talking about Afterpay, and everyone says, well, Visa or the banks can come in and just do their own buy now, pay later scheme. But I don't think it works that way anymore. I really feel that the younger cohort that they're going after are doing it because they don't want to be involved with the traditional banks.
Yeah, I'm pretty sure I thought I saw within the last few days that one of the banks is looking at getting into that space. And look, how do you do it? You make it look warm and fuzzy, right?
It's branding. Yep.
It's got pretty little robots and all that kind of stuff, and
pretty little robots.
and it obviously, they're going for a particular demographic, right? That's the thing. And look, I think you're right. I think a lot of the people that use the Zips and the Afterpays of the world, a younger demographic, potentially don't really have any interest in going through a bank or using a credit card, and rather do it that way. Instant gratification.
Yeah. It's interesting as well. I was interviewing the CEO of OpenPay, which is like a small Afterpay, and that's OPY is the code. And their strategy is to do exactly the same thing, buy now, pay later, but they're going for an older cohort, and they're also targeting different sectors like medical, automotive, dental and so forth, and also to turn it into more of a budgeting scheme rather than a buy now, pay later. So it's a tweaking.
Okay.
Yeah, funnily enough, we seem to be the world leaders in the BNPL space for some weird reason.
Well, I think Australians like debt.
Mm.
You know, Australians like debt. In
We
terms
like,
of per capita, I think,
yeah,
you know, we Australians like debt. But that doesn't mean, you know, I mean, people look. If people want to buy something and they want to use that avenue to be able to acquire that good or service, then whatever blows your hair back, that's what I say.
Okay, so look, we were chatting earlier today about analysts and research, because research. You see research everywhere. You log into your online broking account and there's research from different organisations, but is it really useful?
I think I'm going to answer that in probably two different ways. I mean, we're MF&Co. We do research. We put ideas out, and people go to our website. You can see our research pieces and articles. There's two components to it. There is some good research out there, which is to give people ideas of where they can invest their money.
Yep.
And enjoy the good times and sometimes the bad times in these things. And then you've got the other side of it where you've got research which is done and probably disclosed within the various disclaimers that comes with this research about vying for or saying we have a relationship with this particular company, vying for corporate transactions, corporate deals. So be it a rights issue, bonus, whatever the case may be. So you have to be a little bit careful. I mean, if you talk about, look,
Evan, sorry, can I just be clear here? We're talking about investment banks that are issuing research, but they're also involved in marketing products on behalf of some of these companies. Is that the way it works? Is that what you're saying? I just want to be clear on this.
Yeah, well, not necessarily. So you may have, you may have, like us, we may do a research piece on XYZ, and that's because we believe in the story. Okay.
Yeah.
We want to be vying for any corporate transactions with that particular company. What I'm saying is, this is where a lot of money is made off the back of doing research is by doing corporate deals. So let's say XYZ came to us and we were doing their research and they came to us and said, oh, look, we need to raise some capital. Can you do it for us? Go, okay. This is where it can get a little bit what's the word? Conflicted is probably one way of describing it, but it's not these days. There's a lot of disclaimers and you've got to do a lot of disclosure. So you'll find that a lot of the big bulge bracket, so like the McQuires of the world, etc. There's going to be a lot of disclaimers in, they'll say we do business with these, they may have corporate banking deals or corporate banking that they do, relationships that they do with these particular companies. So that's probably the better way for me to be able to describe the research space. So there's the people that want it. There's companies like us who put ideas out to clients, and then there's going to be shops that'll put research out to clients, but are probably going to be vying, if they can, for corporate fees by doing cap raisings.
But they're obviously not going to be as fearless in their assessments of companies.
I'm not sure about that, because again, I alluded to this before. The compliance space. Compliance has become a very, very big thing. I mean, it always has been, but obviously over the last few years, we've seen a lot of institutions drop the ball. As a result of that, and this is not just here, this is offshore. It's a global thing. There's a lot more disclosure now. There has to be. So
Yeah.
Yes, there's probably going to be some research which you go, okay, that's a good idea, or whatever the case may be, but it's you're not going to read a report and see in the report, we think this company is fantastic. We think you should invest in it. They're probably going to raise capital later on. Don't worry about it. You're not going to see that. Not going to happen. Not going to happen.
Yeah. So, speaking of compliance,
Mm.
one of the things that's annoying you at the moment is the number of YouTube videos that you've seen coming up with people who are obviously not complying with anything, but they're coming on YouTube, acting like experts and pumping certain shares.
Yeah, I think, look, whenever it's the same, look, it's the same kind of thing. Whenever there's a buzz around something, be it property or be it whatever, there's always, when there's hype and there's lots of media attention, and the last few months, there's been lots of attention around the stock market, but the US, maybe not so much here, but especially in the US. I mean, it's just an army of retail. People have never invested in, and I wouldn't even call it investing. I'd probably call it gambling. People are just, throwing money at buying out of the money call options in, Tesla or whatever it may be, and not even really doing this. Just like, oh well, everybody's in there. The Fed's got my back. What could possibly go wrong? And then, markets go up, markets go down. Some people make money, some people get torched. But yeah, to answer your to your comment, I've seen, even locally in Australia on YouTube, I'm seeing a lot of videos from roosters that I've never seen before in my life. Fair enough. I haven't heard of, doing commentary about stocks. So there's one guy I saw. I don't even think he's shaving it. I mean, it's just, I don't think I want to be taking tips. This is the thing, right? So remember that old saying, it's when the shoe shine boy starts telling you about stock tips, you know that the game's over, right? It's kind of the same. It's kind of the same thing. It just has that. It has that look to it. So there's a lot of people. There's a lot of people out there, but in the US, there's stacks in the US. In not the UK, I'm not too sure about, but in Australia, I've noticed quite a few in the last few months. Just people, and then you have a look at the description, and there's just this list of links to this, link to that, so you can see how they're getting remunerated. And I think, yeah, I don't know, where's ASIC?
Yeah. I'll just say at this point as well that if anyone's watching and wants to ask some questions, just type in the comments and your question will come through. I can see, well, how many of there's about 15 of you watching at the moment. G'day. Hey, you referred to call options. So people aren't actually buying shares or stocks in the US. They're buying call options in the hope of the market going up. Explain to us how that works.
Well, so in very, very simple terms, a call option gives you the right but not the obligation to buy a particular security. I'm going to talk about single stock here, not index. To buy a security at a specified time, buy at a specified price by a specific time in the future. So but obviously with options, because they're a derivative and it's a leveraged instrument, you can, you don't need a massive move for you to make a lot of money, and it also goes around the other way. You can lose a lot of money too.
Yeah.
Yeah. So, and this is what's been very, if you have a look at some of the stats, from a year ago, actually, if we go from, say, May last year to May, June this year, the volumes have basically doubled in terms of options activity, and a lot of it a big chunk of it is retail investors. I don't have the statistics. I could probably get them. I don't know what the stats are for us locally in terms of the Aussie market. I'm not seeing anything single stock. I'm not seeing, you know, anything that's standing out. Indexes, there's always activity in the index. Indexes, as you know, is what I do a lot of. You know, again, I do quite a bit of single stock stuff. But yeah, that's to answer your question. Call option. You want the market to go up when you buy a call option, and this is what's been happening. Is that people are going, well, the market keeps going up. I've got to get in. They buy call options. The market goes up. What could possibly go wrong?
So a call option means that you don't have to buy, you know, a whole 100 BHP shares or 1,000 BHP shares. You can buy the equivalent for a smaller amount of money. If the price of BHP goes up, then you make money on that call option. That's the case, isn't it? But then you do your dosh, don't you? If it doesn't go the right way.
If it doesn't go the right. That's right. If it doesn't go the right way, yeah, you learn pretty quickly that it can be painful.
We've got our first question. Putting it up now. Here it comes. It's from Paul Ridsdale. What are the best types of stocks for long-term investors? ETFs, aren't they?
Well, I mean, that's. Thanks for your question there, Paul. That's one way of doing it. You can get exposure to, you know, a sector or the overall market by using ETFs. That's one way of doing it. Portfolio construction with single stocks is right now. You probably have to be a little bit selective about what you know, because one of the problems that we've got is we've got so much monetary and fiscal stimulus through the pipes that it's in some ways it's distorting, in my mind, what could potentially happen later on. So I'll give you an example. I mean, with what the Australian government's done, I mean, they have thrown everything at it, and I mean everything, right? And good on them. They didn't really have a choice, and they didn't know what they were dealing with. They've done a tremendous job in the way that they've made sure that it's what's it about? It's about the machine moving and keep moving. Make sure the wheels are turning, and they've done that. But when this stuff disappears, and it will, then how does it look? So to answer Paul's question, you need to be selective. So you need to be, you know, if you're looking at banks, you might need to be a bit careful there. Who knows what's, you know, there's people doing deferred payments on mortgages, there's business loans. It's just murky. The commodity space has been pretty hot. Obviously the tech space is very, very hot. How long that lasts for, I don't know. Commodity space is probably going to be all right for some time. I think, you know, the consumer staples, I think that's going to be okay. Anything that's kind of defensive. So if you've got Wesfarmers, you're all right. Because, you know, even if there's a pandemic, people still want to go to Bunnings and buy a pot plant, right? So it's you know, that's so there's, you know, you've got to be.
Evan, sorry, is this even the right question to be asking? I mean, we really need to know, or Paul possibly needs to think about his time horizon, what his goals are, how much you know, does he understand diversification? Does he understand diversification outside of the share market as well? There's a lot of things to think about here, rather than just saying, okay, you know, people want easy answers. People want to. Again, I refer to Andrew today, who was talking about this cartoon that he saw once, where there was a queue that said, there was a box that says easy answers, lose your money. The other box said lots of hard work, make money. And there was this big queue right outside the easy answers, you know.
Yeah, right.
It's very difficult to give easy answers because you've got to be yourself all the time. Sorry, I'm just on my soapbox here, Evan. You take over.
No. You're driving the bus there, Phil. But but look. You're right. You made some good points there. It's for Paul. It's very difficult for me to sit here and go, buy this, and this, and you're going to be set, because it just doesn't work like that. But what I would say is maybe investigate an ETF that would give you exposure to large cap stocks that will pay dividends. That may be the first port of call. And then go from there if you want to start getting into being a portfolio manager.
Okay, thank you very much for that. Thank you very much for that, Paul. Now I've got another question here. It's a very long one. G'day, Robert. How are you? Robert's been a long-time supporter of the podcast, and will it all fit on the screen? Hi guys, I have a baby due any day now. Congratulations. Oh, wow. Wait till they're teenagers.
Wow.
And I want to start investing for her future. Would it be more beneficial to set up a trust fund for her, or would it be better for me to continuing investing in my portfolio, transfer her shares from my existing portfolio when she's 18 or 21, etc.?
If I was an accountant, I'd be able to give that a bit more colour. But yeah, you really, Robert, you really need to talk to your accountant about that one. I mean, look, you can hold the shares. I'll give you a very brief comment about, you can hold the shares because anybody under 18 can't hold shares in their own name, so they have to. It has to be held by a parent or a guardian. So you could hold the stock for your child. It'll be in your name and your partner's name, and you'd have a designation of the baby's name underneath, and you can do that till they're 18. And after that, you could do an off-market transfer. But before you get to that, you'd want to talk to an accountant. Trust is that's a whole different animal.
What about investment bonds? I keep on hearing about it. People getting investment bonds for their kids.
Yeah, I've never had any client of mine ever ask me any questions about investment bonds. I can't talk to it because I don't deal in that space.
Mm-hmm. Yeah. Okay. Thanks very much for that, Rob. Now, we had a couple of listener questions from beforehand, and I know that you're a big fan of avoiding single stock shock, Evan. So what are the best ETFs for starting out? And I think we should be talking about low-cost index ETFs here. And this question is from Lee Liz. Hi, Lee, if you're watching tonight.
Yes. Thanks for your question there, Lee. Look, Phil's right. The better thing to do is to, find an ETF that's not going to be taking a lot of fees, but a lot of them don't, especially the bigger ones like the Spider, Street Tracks, ASX 200 ETF. They're not, the fees aren't really a big consideration. So in my mind, so you can start there. You'll have it within that particular ETF, for example. You'll have diversification. So you're not sure. You may have the market go up and the market go down, and obviously the price of the ETF will move accordingly. And then again, this is to say an index type ETF. But yeah, that's probably the better way to go. And single stock shock, and I'll give you a classic example of what I mean by that. If you bought, for example, in the last 5 years, Telstra, Maya, AMP, your portfolio is probably looking a bit sick.
Once great names.
Yeah, so your portfolio is looking a bit crook. So in order to not have that happen to you, and And look, it happens to a lot of people. You think, oh, AMP, just it can't go below $3. Want to bet? Telstra can't go below $6. Want to bet? Can. CBA, they won't go below $70. Want to bet? So it's just you got to be very careful. You got to pick your timing with these things if you want to build a portfolio of stocks. And you've got to be, but again, there's so many things going on in the world right now where you've got to be very careful around where your exposure is. I mean, if people buying, imagine that person that bought Afterpay. What was it? 80? What did it get up to? 80 or something? 80 something dollars? $92. I think it got up to.
Mm-hmm.
Imagine if you bought Afterpay at $92. Good luck. So yeah, so with an ETF.
Part of the point is, I think, because people see so many different kinds of ETFs, and it's the terminology around ETFs that's so confusing. Active, passive, index, thematic. What is the description of the most basic ETF? I mean, you mentioned the Spider STW, I think, from memory. What's the overall terminology that would be used to describe that kind of ETF, so that they can use that? Listeners can have a listen to that. Listeners can look at that kind of ETF as a starting point.
Yeah, well, that one's an index ETF, and what it does is it looks to replicate the ASX 200 or mirror the ASX 200. So within that ETF, they're going to have obviously they're going to have CBA, BHP, Worley. They're going to have basically they'll have an allocation of the top 200 stocks. That's how, and they'll look to mirror the index. That's the best way so it's just basically a basket of 200 stocks.
Yeah.
And they'll have certain allocations to each one. And then obviously market goes up, the ETF price will go up, market goes down, that'll go down too. So it's very diversified.
And something I always recommend, well, I'm recommending a lot to people these days, if they're interested in finding out about ETFs, ring up the customer service people at the ETF providers, ring up Vanguard, ring up Beta Shares, ring up eInvest, and hassle them. Keep ringing them until you understand what's going on.
And go and have a look at the. Have a look at the the ASX has got some good resources. The ASX website. They've got some good resources there about ETPs or ETFs, exchange traded products, ETFs. They've got some good resources there, and then you can, in terms of providers, or sorry, in terms of shops that do ETFs in Australia, the main ones in my mind would be Vanguard, VanEck, iShares, State Street, and Beta Shares. Beta Shares are a big player. They've got some really interesting stuff. So they're probably the main ones. Just have a look at the website. They've got lots of information there and brochures and how do you understand this.
Ring and talk to them.
Absolutely, there's people there to talk to about these things. Yeah.
And if I can put a plug in for the next episode of Shares for Beginners, I've got a gentleman on, Daniel Rays, who worked for Vanguard, and Jack Bogle, who was the founder of Vanguard, who was the pioneer of ETFs. Daniel sat and had lunch with him and had peanut butter and jelly sandwiches with him in the cafeteria several times. And apparently a very down-to-earth who could have made a lot of money, but instead chose to help individual investors instead.
Oh, good on him. I'm sure that he'd have a lot of stories to tell, a lot of information.
We got another question. Hi, David. I hope I'm loud enough now. Thank you for that. I fixed up my level, and thanks for the warning there. Apart from ETFs, what is the most cost-effective way of buying foreign stocks?
Well, I mean, you could directly buy. If you want to go and buy Tesla, or if you want to go and buy Morgan Stanley or whatever stock you want to buy, you can probably do it online. There's not many brokers in Australia do it. We can do it. We can do it for people. We're able to get people exposure to direct stocks offshore.
You've got a night desk, haven't you?
Yeah,
That's
we do.
dealing with US markets.
Yeah. We have a night desk that deals with US equities, futures. So yeah, options, all that stuff. So yeah, if you're interested, you can give us a ring. But in terms of there's not a lot of broking houses in Australia, or a lot of financial service providers that offer that kind of thing.
I could also mention tracers. Chi-X offer tracers. Have you heard of those, Evan?
Yep. Yes, I have. Yes, I have heard of those. I haven't done a lot in that space.
So,
yeah, and of course, as you go back to the ETFs, there's lots of ETFs that give you exposure to offshore, and you let somebody else manage it for you. You don't have to be sitting there at 2 o'clock in the morning going, "Oh, what's happening?" So,
yeah, and there's also all the difficulty of the paperwork in owning foreign shares.
Yeah, well,
especially
you've got to
the United States as well.
Yeah.
There's a lot of
you've got to complete WA Ben form and all that stuff, and everybody wants lots of proof of who you are. So, lots of paperwork.
Okay, so I've got a listener question that came in before. This is from Patience McQuire. I think she's in New Zealand. I think she's a Kiwi.
Oh, very good.
And she wants to know about building a diversified ETF portfolio. And I think this is where we can start talking about all the kinds of different other styles of ETFs that one can invest in.
Sure. Well, again, you've got to work out what what kind of risk you're prepared to take. You've also got to have a bit of an understanding of the different types of asset classes. So, I mean, in terms of ETFs, you can. There's commodity ETFs. There's obviously there's index ETFs. You can get currency ETFs. It's all different types of ETFs. There's about 6 or 7. And it's from Australia. There's an
bond ETF,
like Vanguard, the government bond ETF. There's about 6 or 7 different. Yeah, that's exactly right. So, it comes down to what you understand, what kind of allocation you're going to want to have to each type of ETF that you're looking at investing in. So if you want to have a little bit of, say, a commodity one in gold, for example, you might want to have one that's in government bonds, and you have one that's more of an equities-based one, and you spread it out accordingly to how what you feel comfortable with and what you feel comfortable having exposure to. And also your understanding, because it's important. If you start getting into stuff like commodity ETFs and you start getting into currency ETFs and that kind of thing, you really need to know what you're getting into.
Yeah, you need to do your own research seriously, don't you?
Because when you call up any of these ETF providers, they're not going to give you advice. They'll tell you what's in there. They'll tell you, they'll tell you what the fee is, but they're not going to say to you, you should buy this, you should sell this, you should buy this. That's not what they do. They'll give you information about the particular product, but that's about it. They're not going to tell you to buy this, sell this. That's not going to happen. So you have to do your own research or talk to somebody who knows about it.
Yep, and keep learning. Just keep learning.
Correct.
If I can just do another plug on this particular subject, I've got a chap called Graham Hand from First Links coming on the podcast. I'll be interviewing him next week, and the episode will be out in a couple of weeks. And he's got some excellent examples of ETF portfolio constructions. And one of the ones that he's got is an ETF portfolio that exactly mirrors the future fund, which is an interesting idea.
Yeah, okay. That's interesting. Yeah, okay.
Yeah, because the future fund's done pretty well, hasn't it, Evan?
Yeah, it has. I mean, they've got some pretty smart people running that. But yeah, I mean, that'd be very interesting to see that. Yeah.
Yeah, it's going to be an interesting episode. So once that comes out, I'll have I'll be showing the chart that will show this. Now now this is I've got another question here. This is from Lee J. Dale, another previous listener question, and this is quite an interesting question in terms of it's something that's in the news every day, but seemed to have more importance a couple of months ago. And what he asks is, how will the announcement of a potential vaccine affect the ASX and potential stocks to keep an eye on? So thanks for that question, Lee. But remember a few months ago, it just seemed to be everything was, is there going to be a vaccine? Is there not going to be a vaccine? And there's an assumption now that there will be a vaccine. Is that the way you're seeing it, Evan?
Yeah, and I think maybe 2 or 3 months ago, you'd have these big runs in the market on the upside, where somebody's come out saying, "Oh, we're working on a vaccine and we think it's 3 months away," and then the market would absolutely ramp, and then a few days later they say, "Oh, the trial isn't gone as well we'd have liked," comes off. Yeah, I mean, look, and it's still happening now. You still you get these headlines that will come out and saying, "Oh, there's a potential vaccine or positive news on a trial that's working," or something like that. To answer the question, I think the market will just rocket. I mean, we've been lagging, but and obviously in terms of potential stocks to keep an eye on, well, obviously you want to be looking at your healthcare stocks, especially if it's the CSLs of the world, guys like that. Whoever's involved in that space.
But the interesting thing about CSL, because they're signed up to provide the vaccine.
Yes.
But how much money are they going to make out of the vaccine? Are they going to be making money? Because the government's going to be funding it, and the government's not going to want to just give away money for jam to a company like CSL.
I'm sure they'll get paid. I'm sure they'll get paid for it. What it looks like, I don't know. But but to answer the question, I think that there's any headlines you see that are going to be positive around a vaccine, and somebody hasn't got sick and all this kind of stuff. They've been able to do it on a number of people, and it's working. Or there's I just think that the market's going to rocket because it's primed. There's so much juice in terms of monetary policy. And really, I keep saying this, when you're in a virtually a zero interest rate world, where else do you go? Where else do you go? Where do you get a return?
I know, but then I don't know. There could be some real disastrous scenarios ahead as well, and not necessarily economic but political disasters. America-China relationship. The US election. A lot of dark clouds on the horizon. It's not. I don't think we can take it as being all future.
You are 110% correct, Phil. That's exactly right. There is a lot of uncertainty out there, and markets don't like uncertainty. Markets don't like that. But
the vaccine's not the thing that's going to fit. Yeah.
I just think that you see what's. I mean, again, I go back to my story about retail investors. Especially in the US, in terms of the options, it's unbelievable. It's breathtaking. It's just, and this is the thing. People want to get a return on their money. They can't put it in the bank.
Yeah.
And if you think about it, where are you going to get? I mean, look, okay, people may trade currencies, great. Trade futures, all right. Where do you buy a house? Okay, but you got costs with that. It's harder to get out. You got a liquidity problem, right? Generally, equities, options. You don't have a liquidity problem. You don't. You may not get the price that you want, but you don't have a liquidity problem. If you said to me, Phil, if you said to me, Evan, I want to get rid of 100,000 ANZ shares tomorrow, can you do it for me? No problem. No problem.
Yeah.
You may not get the price that you want, but if you said, I need to get out of that market, I want to get out, no problem. And you'll have your money in 2
That's
days.
there. So we've got another question here from David. Hello, David. Thank you very much for hanging in there. I understand super funds can own unlisted assets. Are there ETFs or LICs that have unlisted assets in their holdings?
There may be, but it's probably more like a private equity thing. Yeah, I don't. All the ETFs that I know of have some. There's a listed tradable asset within the ETF.
I'd point you, David, to the episode with David Kirk, who's the CEO and co-founder of Bailador, and they've got an LI. Well, it's kind of like a listed investment VC fund where they've got 10 companies in their fund, only one of which is listed, and the rest are growth stage companies. Have a listen to that episode and have a look at Bailador, BTI. It's most probably not exactly the sort of thing that you're asking about, because when we talk about private equity, Evan, it's a whole different asset class, isn't it? Tell us about
animal.
Private equity as an asset.
It's a different animal. It's basically it's basically where you'll have. I even think that there's somebody I saw today's launching a new, like a private equity type fund where they'll go and invest in, maybe assets or companies, and get a return from that kind of activity. But it's not really a space that I don't really deal in the unlisted space. I only deal with stuff that's listed. It's all about, everything to me is about liquidity. All about liquidity. If you're not liquid, then it's challenging.
And really, if you want to get into that space, what's the problem with doing it in your super fund?
I'm not sure. Again, I'm not an accountant, so it's probably beyond my abilities, I'd say. So you need to talk to an accountant about that.
Yeah. So we're recording this on Tuesday, the 15th of September. What are you seeing over the next couple of weeks, Evan, in the market, in the Australian share market? Let's just keep it simple.
Yeah, I think locally it's. I just think it's going to be pretty much the same as what we've seen over the last few weeks. I'm not expecting massive rallies, and I'm not really expecting a massive sell-off unless we have something. I mean, you never know. You get a headline that China's doing this, or US is doing that, or some kind of headline that throws everything off a bit. And I mean, if we get more headlines around ideas, or not ideas, good positive news flow around vaccine, I think that'll drive markets higher. But I'm not, all the reporting's done for us locally. Most of it is, it wasn't, obviously wasn't good, wasn't bad. I think a lot of people I think the market took in stride. So I'm not really expecting anything out of the ordinary at the moment. I think we're just going to be very range bound until we get some good news in the market. It moves higher, and if there's weakness offshore, then we'll get dragged down with it.
Yeah. And Evan, you've spoken to me too about what you've seen as a correlation between the value of the Australian dollar and the value of our share market. And you pointed out that they're almost in lockstep with each other.
It seems. I mean, look, it's not always like that, but if you have a look, I mean, even some days, intraday, because I run a lot of intraday charts. You can have some days where US. I mean, even today we had S&P futures were moving higher throughout our session. the Aussie dollar was moving higher throughout our session, and the SPY was just going nowhere and heading south. So there is a bit of I do notice a correlation there. I think at the moment, I just think with the local market, I just think people are probably just a little bit hesitant to really commit at the moment, and yet I don't think people really want to do a lot of selling. And I think on dips, people are going to get set because there's just a hunt for yield. Everybody wants to get some kind of yield, even though we know that companies have deferred dividends or benched them altogether for this season, this time around. But, you know, once things come back to normal, and they will come back to normal, once, you know, there will be some normality in terms of hopefully we'll get this vaccine sorted out and things will start, you know, getting back to normal. You know, but again, I think people want to get set for yield.
So basically, things are going to be just in that range, the ASX 200 range that you described, unless there's a vaccine, in which case there's a rocket emoji, and or there's going to be some bad geopolitical news, in which case it's a sad face emoji.
Correct, a very sad face emoji. Yeah, that's exactly right. Yeah, I just don't see anything right now that's gonna. I just think we're going to be stuck in a band, and until we breach those levels, then we'll you know, if it's bad, then we're going to be heading further south. If it's good, up she goes.
Okay, Evan, thank you very much for your time tonight. Thank you very much for joining us for this Facebook Live. I've really enjoyed chatting with you, as always. It's like one of our phone chats, but in public. So we haven't been able to swear as much.
No, we've been on our best behaviour today, Phil. But no, thanks, mate. Thank you very much for inviting me on, and always a pleasure to chat with you. And yeah, really enjoyed it. Thank you very much.
Okay, thank you very much, Evan. Bye for now.